We want to thank everyone for joining us today. My name is Steve Davis. I'm the co-head of the Akin Gump Energy team. While currently based in Houston, I practiced for a number of years from a Singapore base. Before that, I worked as an engineer for a period in Abu Dhabi and Bahrain, mostly on pipeline work relating to Das Island, one of the original LNG projects. Akin Gump is pleased to co-present this program with our friends at Gaffney, Cline. Before we continue, a few housekeeping items. The audience is on mute to prevent any background noise. We will host a Q&A session at the conclusion of the presentation. Please submit questions as you have them during the presentation through the chat box feature, and our speakers will address them at the end. We're very pleased to be doing a joint presentation today with Gaffney Cline. Gaffney Cline is an international energy consultancy which has been operating worldwide since 1962. It specializes in the provision of policy, strategy, technical, and commercial assistance to entities in all sectors of the energy industry. Gaffney Cline's work enables governments, regulators, explorers, producers, and their financiers to navigate economic and technical uncertainties and make informed decisions. Okay, no surprise, but we continue to live in interesting times. Let's talk with some very knowledgeable people from Gaffney Cline and Akin Gump to get some current and helpful information. Andrew Duncan is a principal advisor in Gaffney Cline's Singapore office. He has over 35 years upstream oil and gas experience, including with natural gas markets in Australia and Southeast Asia. Paul Greening is one of my partners in Akin Gump's Singapore office and holds particular experience in LNG project development and LNG marketing. Nick Fulford is global head of gas and LNG for Gaffney Cline and has over 35 years of experience in the natural gas sector, working on all aspects of the gas value chain. Michael Joyce is also my partner in Akin Gump's Singapore office and leads the firm's energy practice at Asia. Philip Solomon is a principal advisor in Gaffney Cline's Singapore office. In his 27-year career, Phil has developed experience in all dimensions of the oil and gas value chain and has worked throughout Asia, the U.S., and Australia. Now to some questions. Nick, you first. I know the team at Gaffney Cline follows market developments very closely. What can you tell us about the latest developments and their impact on the region?
Well, thanks, Steve. And I also wanted to extend our thanks to the Akin Gump team for this collaboration, coming at such a key time in the LNG sector in Asia Pacific. Now, although I'm speaking to you today from Houston, you will be able to tell, no doubt, that I'm not actually from Texas. So I'm in a good position to tell you what many of you know already, that there are many differences between how things are done in the U.S. and how business is conducted in the Asia Pacific region. Some of these are legal and regulatory, but some of the most important ones are cultural. So today I wanted to begin and end my introductory comments with two sayings that I think sum things up very well in today's global gas sector. The first is a well-known and, to my mind, a very valuable observation in Tolstoy's War and Peace. It's a comment offered up as part of a debate on military tactics, and it goes like this. The strongest warriors are these two, time and patience. For the last 50 years, this philosophy could have summed up the LNG industry. Projects sometimes decades in the making, counterparties developing trust and confidence over many years, continuing through the start of deliveries, sometimes through 2 or 3 expansions or remarketing phases. Now compare that approach with the fast and furious pace that's characterized the U.S. entry into the global gas space. New pricing mechanisms, tolling contracts in some cases, and what might be seen as a much more commoditized approach, borrowing heavily from the very deep and liquid wholesale market in North America, with its sophisticated trading and financial markets that are really so unfamiliar to the old world of LNG. So are we to rely on time and patience to bring returns and sustainable economics back to the global gas sector? Do we need to borrow from the tried and tested approach that's characterized Asian LNG for so long? Or do we need to look at the novel approach that's characterized the U.S. entry into the space? It's worth reflecting on the events of the last couple of years as we consider that. Since early 2019, we've seen a gradual erosion in the value of LNG traded outside long-term contracts, which reflects a rapidly growing portion of the LNG trade in Asia. From the start of 2019 to the start of 2020, prices roughly fell by about a half. And since the start of this year, they've fallen by more than another 50%, with a little sign of recovery on the horizon. There's so much going on right now, you'd be forgiven for thinking that other than going along for the ride, a long-term strategy is hard to devise. Many of our clients in the LNG space are coming to us for a view on how the global gas sector will restabilize after so many momentous shocks. And of course, a good place to start is with two fundamental features of the global gas market: supply and demand, and the fundamental economics of the gas value chain. Now, what's become clear in this last couple of years is that natural gas is a fundamentally lower cost fuel to produce and deliver compared to oil and its derivatives, provided the costs of liquefaction and freight can be properly managed. With energy demand continuing to grow rapidly in Asia, even under the most aggressive renewables assumptions, new gas demand will drive well over $100 billion in LNG-related investment over the next few years. Of course, the question that goes with that is, what price will gas consumers have to pay to make that investment pay off? Now, at this point, I wanted to hand back to Steve with the second of my sayings. With traded gas price in recent weeks dipping below the $2 mark, should gas buyers count on years of low price? Well, some of you will have heard the phrase from ancient Greece, one swallow does not a summer make. And the answer, of course, is that what we're seeing right now is the result of exceptional times. And over the next 45 minutes or so, we can develop a little bit more detail around where the Asian LNG sector is headed. Back to you, Steve.
Thank you, Nick. Time, patience, and swallows. Good advice from the Greeks, Mr. Fulford, and Tolstoy. Phil, with such a lot of volatility and depressed pricing, what are you hearing from your gas clients more generally here in Asia?
Thanks, Steve. I'll also join Nick in thanking the Akin Gump team for the collaboration on this event. The situation here in APAC is always interesting, one being both a major supplier and an even greater consumer of LNG. But as Nick said, let's look at both the short and the long term. In the short term, it's volatile, driven by traders and tweets. In the longer term, however, fundamentals matter. On one hand, we have an LNG supply glut driven by the confluence of a sustained and, it must be said, expected long supply market, together with oil-linked contract pricing, which is driving prices down. That colliding with a COVID-driven demand slump makes a very unholy trinity. The result? Buyers are looking for reasons not to take cargoes, laden ships at anchor with no destination. My legal friends here at Akin Gump may be able to comment on the commercial mechanisms buyers are using, but the result in a long spot market and the resultant scramble to clear those cargoes is leading to very low prices. Traders here in Singapore weep at the prices that cargoes were cleared for in April and May, setting record lows. June saw a bit of a comeback and a bit of buoyancy, but forecasts for the northern summer are grim. In recent days, there were reports of a US Gulf Coast cargo being sent back from Europe simply because there was no capacity to offload it into the system. This does not bode well for European pricing in the northern summer, which in turn is likely to have flow-on effects into Asia. Again, in Asia, there was at least one customer I'm aware of that was calling FM on their term contract, but was known to continue to purchase cargoes on the spot. However, more unexpected in this situation is the exits we're seeing from at least two major APAC LNG producers. As has been noted in the media, both Eni and Chevron are selling their stakes in their LNG projects in Australia. Eni at the Darwin LNG project and Chevron in their Northwest Shelf. Now, one might argue these assets are mature, not a strategic fit, will require significant capital to bring on new production and so on, but it's the timing that I find interesting. Chevron and Eni are clearly willing, but not distressed sellers. Bringing these assets to the market during a low commodity price period indicates to me one of two things. Either they see no end to this price route and are making a strategic exit from Asia before conditions worsen, if they possibly could, or that they, and by extension any proposed buyer, do not see a prolonged route in pricing and are suggesting that the current market is a blip when considering the ongoing life of the LNG or the Northwest Shelf. I tend to believe the latter. These assets are very long-term investments and will see several cycles during their lifetime. Both assets are within reach of fields that could supply them for decades to come. I'm sure that there is probably both views held within their companies. A steady hand at the helm will see the ship through the COVID squall, but what might begin to see when the sun breaks is a new generation of pricing mechanisms that remove at least some of that volatility, but perhaps we'll touch on that later.
Phil, thank you. That's great information. You and Nick both have commented about the long-term investments. Now these things really have a life of their own. Phil, thanks again. So now let's hear from the lawyers. Paul, you first. Can you describe what you've seen in Asia from buyers in terms of their response to COVID-19 and what options they have been pursuing to limit their exposure to take-or-pay liability under their LNG offtake arrangements?
Thanks, Steve. And as both Nick and Phil just mentioned, despite there being some recent improvements on the demand side, particularly out of China and India, the demand outlook is negative. And generally speaking, the reduced downstream demand for regasified LNG in the region during the COVID-19 period and the limited storage available resulted in some Asian LNG buyers being physically unable to unload scheduled cargoes, forcing some buyers to turn away cargoes and seek ways to reduce their obligations under their long-term LNG SPAs. So what options do buyers have under their SPA? Whilst SPAs set the agreed annual contract quantities and the price of LNG to be acquired by a buyer on a take-or-pay basis, the buyer is usually permitted some flexibility. For example, SPAs can provide for the deferral of delivery of a portion of scheduled cargoes or the option for the buyer to exercise downward quantity tolerance, which allows the buyer to fall short of its take-or-pay commitments without incurring an obligation to make up that shortfall in the future. Buyers will usually also have a right, subject to profit share arrangements with the seller in the case of a DES contract, to divert cargoes to a more profitable destination or to an LNG facility in which it can obtain storage capacity. Cancellation rights are also often referenced as options for buyers in the current climate, but the right to cancel outright certain LNG cargoes has historically been resisted by sellers, and so we don't view this as a standard feature across all SPAs, but it has certainly been more popular over the last few years and will no doubt increasingly be requested by buyers in negotiations of long-term SPAs going forward, as I'm sure Michael will touch on later. So let's look at which of these options have been used in Asia. Well, buyers have certainly been triggering deferral rights, DQT entitlements, diversions, and where they are available, cancellations. And we've seen these used extensively over recent months by Japanese and South Korean buyers. However, there are, of course, limitations to these flexibilities. Deferrals and cancellations are for limited volumes, and DQTs generally only permit reductions of between 5 to 15% of the ACQ. Moreover, DQTs can often only be triggered on operational grounds rather than for economic reasons, and usually have to be agreed in advance of the annual contract year rather than triggered on an ad hoc basis. This therefore limits their utility as a COVID-19 response tool. In order to obtain a more significant shift in the contractual arrangements, the buyer may look to renegotiation as an option, but their ability to do this will depend on the terms of the price review provisions in their SPA, which Michael will discuss in some detail later, and otherwise on the strength of their relationship with the seller and the term remaining on the SPA. As a last resort, a buyer may look to force majeure. So what is force majeure and how can it be triggered in the context of LNG SPAs? There have been many webinars held over the last few months on this topic, so rather than go into great detail, I'll just summarise the key issues at hand. Under English law, which is the most common choice of governing law in long-term Asian LNG contracts, FM is a form of relief that is available only if and to the extent provided in the relevant contract. Whilst there is no standard form FM clause, in general terms, long-term LNG contracts typically require the following elements to be satisfied. An FM event has occurred that firstly, is not reasonably within the control of the party claiming FM. Secondly, could not have been prevented or mitigated. And thirdly, it has prevented, hindered or delayed some aspect of performance. Often, FM clauses will also include a requirement that the party calling FM must have conducted itself as a reasonable and prudent operator. Usually, the FM clause will give a non-exhaustive list of events that would be regarded as an FM trigger, as well as a list of events that do not qualify as FM. It is common to see pandemics and epidemics specifically listed as an FM trigger event. It is also common to exclude market changes or reduction in demand as being a valid reason to claim FM. The party claiming FM must also promptly give notice of the FM event and satisfy the specific timing and content requirements of the FM notice provisions. If all of these requirements are satisfied and substitute performance cannot be negotiated, then FM relief may be available. If the force majeure is prolonged, then provisions in mid-term or long-term SPAs may allow one party or either of them to terminate the LNG SPA. So to what extent have force majeure claims been made during COVID-19 and how successful have they been? Well, China, with CNOOC leading the charge, was the first to issue FM notices in February of this year. These notices were supported by FM certificates issued by the China Council for the Promotion of International Trade. They were subsequently disputed by Total, Shell and Qatargas. India was the next to issue FM notices as they entered lockdown. GAIL and Gujarat State Petroleum were amongst the first to issue such notices. Petronet have also recently confirmed that they invoked FM on 8 LNG cargoes from the Qataris and 1 from Exxon for loading from March to May. Again, Exxon and Qatargas have objected to the FM claims and the parties are still in discussions to resolve that dispute. One of the reasons that the Chinese and the Indian buyers were seeking FM relief under their SPAs was because domestic demand, such as demand from industry and the power sector, had at the time been much lower than usual, leading to insufficient capacity in receiving terminal storage tanks. In the face of an express clause excluding market-based claims, we view it as a very difficult proposition for a buyer to substantiate an FM claim on this basis alone. It's also worth noting that operational issues at terminals may also not permit an FM claim. In many cases, the pandemic itself and even lockdown may not prevent an LNG import terminal from unloading LNG, given the automation that is available at many terminals. The success or otherwise of FM claims arising from COVID-19 will likely take some time to fully come to light, but there is one overriding point to all of this. Long-term contracts require long-term relationships, and sellers and buyers will be keen to preserve their relationships and generally avoid arbitration. The issuance of FM notices or even the exercise of DQTs will often therefore trigger a path to renegotiation rather than a suspension or termination of an LNG SPA or the escalation to a dispute. Thanks. Over to you, Steve.
Thanks, Paul. That's very comprehensive, and I really support that last part. The parties really do want to talk a lot before resorting to any kind of dispute proceedings. So now let's turn back to the Gaffney Cline team. Nick, I think you first. With all this contractual disruption and so many different factors blurring the future outlook for gas demand in Asia, what can you tell us about the longer-term recovery in demand?
Well, thanks, Steve. And let's think about these developments for a moment from a contractual point of view and what they mean commercially, especially in today's changing downstream markets. So many of the contractual features Paul mentioned are to do with buyers demanding more price and volume flexibility, which really has been key for survival in the demand crash we've witnessed in recent months. But this isn't just a feature of today's softer demand. It's also a feature of how these gas buyers are beginning to do their business in today's increasingly unbundled world. Now, North America was the first large gas market to separate supply from transmission and to introduce a choice of supplier for large energy consumers. The major gas and power restructuring in the UK followed a similar pattern in the 90s, followed by the rest of Europe in the 2000s. And all these major market transitions have left a large legacy of stranded gas contracts, price reopeners, and take-or-pay amendments, and so forth. So let's consider why for a moment. So in the old days, with gas and power customers tied to a particular utility, they had no option but to pay the fuel prices that these gas purchasers had agreed as part of their long-term purchases. And those same buyers were secure in the knowledge that their industrial, commercial, and power generation customers were tied to the system in a way that provided a great deal of certainty around volume. Minimal take-or-pay flexibility could be accommodated with guaranteed price recovery from a captive customer base. Little incentive existed to trade around a range of suppliers to find a better priced cargo. So all that's changed, and the market restructuring is now well advanced in Asia as well. This includes the energy market reform process in Japan, for example, and similar competitive models developing in Korea, and of course China too, with its continuing efforts to push TPA and access to LNG terminals and pipelines. So for example, for an LNG to power IPP, an inflexible contract priced badly can mean financial disaster. As LNG starts to commoditize, volume flexibility and access to some sort of market clearing price linked to supply and demand, as opposed to a cross-commodity proxy such as oil, starts to matter a lot. So let's consider an example from recent weeks. A single cargo of LNG usually amounts to around 4 BCF of gas. At $2 an MMBTU, the cost of that cargo would amount to around $8 million. With oil-linked prices typically in the 12% range and oil hovering around $40 a barrel these days, that comes to around $20 million. And what's more, it's sometimes the same LNG from the same exporting terminal, but sold outside the constraints of a long-term take-or-pay arrangement. With a 2 gigawatt station needing around 2 ships of this size every month, that's a $24 million saving each month from turning away a contractually committed cargo and taking a spot cargo instead. And Phil, I think you had something to add on that as well.
Yeah, Nick, you've neatly quantified the real issue, I think, and it's the size of the prize. From a buyer's perspective, testing the limits of your contractual arrangements can offer a substantial payoff. Might it be a negotiating tactic? To avoid lengthy legal uncertainty, we might begin to see reopeners and amended terms as part of the settlement to any arrangement. But what about new demand? When a commodity is long, it's natural to foster new customers. Gaffney Cline's watching the emerging demand from LNG shipping and hydrogen very closely. Merchant shipping, as an example, is one of the biggest remaining users of heavy fuel oil. However, HFO is rapidly losing appeal, not least of which because the IMO requirements around emissions and requirements for scrubbers and so on are other measures for dealing with emissions, but also because technology and logistics required to power large merchant vessels on LNG is becoming commercial. LNG-fueled ships have become a regular feature on shorter European routes, but now we're seeing it emerge as a demand in long-haul merchant shipping in Asia, iron ore routes and container traffic, for instance. This represents a major new source of demand for LNG and somewhere to sell those cargoes. Major shippers such as Maersk, MOL, even Rio Tinto, MSC, and the leisure lines, Carnival and Disney, have all announced an intention to decarbonise bulk shipping and cruising and are shifting to LNG. They're supported, as you would expect, by the global producers. Shell, Total, Woodside are all active supporters of the conversion. And the energy demand is quite significant. If you were to take all of the HFO fuel demand across the world, it converts to about 240 million tonnes per annum in LNG terms. Take the cruise industry, another victim of the current COVID crisis, but the fuel burn of cruise ships calling into Australian ports in the summer cruising season is estimated at 3 million tonnes per annum in LNG equivalent alone. That's nearly enough offtake to keep an entire train on Curtis Island busy for a year. At the end of last year, the count was 170 large vessels in operation and a further 120 on order. Global LNG bunkering demand is forecast to grow 70% this year, albeit off a small base. Korea Development Bank forecasts that 60% of orders for large vessels will be LNG powered by 2025. The forecast for marine fuel LNG demands are currently posted at a 50% CAGR for the next 5 years. The LNG marine industry has overcome the technical challenges, has the carrot of pricing and the stick of emissions controls, and is growing rapidly. The enabler is bunkering, though, and the growth that has taken off. So I believe this is the space to watch for demand growth.
Thank you, Nick and Phil. This is really great information, and I agree completely on the bunkering side. Andrew, I know you've been supporting clients on some of the more innovative Asia-Pac projects. Can you tell us a little bit more about that?
Yeah, thanks very much, Steve. I mean, following on from what Phil was saying about establishing break bulk facilities to support the marine fuels industry, as marine demand builds in the region, of course, you'll see a parallel rollout of break bulk facilities throughout Southeast Asia, starting with the end points of the major shipping routes. Now, as you know, Southeast Asia is a huge geographical region, characterized with thousands of inhabited islands and many more uninhabited ones. And all these are supported by marine supply routes and small-scale, usually diesel-fired power stations. And as the rollout of LNG distribution facilities expands throughout the region, it's logical to expect that LNG will begin to compete initially as a power station fuel, and then potentially in other fuel markets. And in a market like that, where LNG is competing against diesel fuel, it's a premium price market, if you will. Now, this is already happening in Bali. Bali was one of the early movers for LNG import for power station usage. There's an FSRU on site, and it's delivering gas into the power market. Indonesia is also slowly rolling out FSRUs for power supply throughout the country. The old Arun LNG export facilities have been converted for LNG import, and further FSRUs are either on station or planned in Java and South Sumatra. And this has also seen the interesting development of a domestic LNG trade in Indonesia, starting initially with the domestic market obligation LNG cargoes that are available to supply domestic demand in the archipelago. I mean, similarly, in Australia, we see LNG import projects being proposed in Eastern Australia to take advantage of the pricing differentials between world and Western Australian LNG prices and the East Coast domestic gas pricing.
Andrew, thank you very much. I worked on the Arun LNG project when it was an export and then got turned around, the exact opposite of what we saw here in the United States. So change continues for sure. Now let's hear from Michael Joyce. Michael, with the disruptions we've heard about in the market and buyers and sellers looking into their contracts for relief, will companies also turn to price reviews to get price relief and potentially to arbitrations for take or pay or delivery relief? And if so, what are some of the issues to consider?
Thanks, Steve. Even before COVID-19 started impacting LNG markets, there were significant commercial incentives for buyers to seek price adjustments under long-term LNG contracts. But with the advent of COVID and what appears to be a lower for longer price environment, I think the incentive to trigger price reviews only appears to have increased. While there is no standard form of price review clause in LNG contracts themselves are extremely confidential, the clauses have developed over time, and so today, many LNG price review clauses, while complex, share key elements in common. Essentially, there are three elements to price review clauses. The first is the trigger for the review, the next is the process for the review, and the last is the methodology for the review. Turning to the first element, the trigger. Typically, there is one or more specified triggers that the requesting party must show has been satisfied. Frequently, this may be the passing of a period of time. For example, a first review might occur after a set number of years from the date of the first delivery under the contract, and subsequent reviews at stated intervals thereafter, for example, every 5 years. Instead of, or sometimes as well as, being triggered by a time requirement, the trigger can be that a significant or substantial change has occurred in the buyer's market prior to the review date. Alternatively, an element of the trigger may be a change having occurred in the market price for LNG. These triggers give rise to considerations of whether the changes in the buyer's market or market generally are one-off, of short duration, or continuing in nature, and of course to considerations of what is actually the market for the purposes of the contract. For example, if part of the trigger relates to the prices in the buyer's market, is the market the country in which the buyer operates, or only a defined geographic area within the country? It is also very important to comply strictly with the notification requirements for the trigger, or else the parties run the risk of being denied the opportunity to undertake a review. Needless to say, disputes are common about whether all of the different elements of the trigger are satisfied and what they mean. The risk of such disputes can be reduced the more specific the drafting and the more objectively clear the stated criteria. So once the clause has been triggered, the next element of the clause is the process. Effective price review clauses should set out in clear terms the process the parties should follow once a price review has been requested. Typically, there will be a requirement for negotiation to be held over a stated period. Given the very long-term nature of LNG contracts, parties should make every endeavour to try to maintain their relationship. So the negotiation period needs to be adequate for the parties to be able to achieve an amicable result following the opportunity to gather and present relevant evidence to support their positions. This is particularly so if failure to agree gives rise to a party having the right to terminate, or for the matter to be referred to arbitration. Again, compliance with the process is critical both to achieving an agreed outcome and to preserving the right to dispute the outcome in the event of a disagreement or no agreement. And indeed, it is common in modern LNG contracts to explicitly allow a party to have the matter referred to arbitration for resolution. The final element of a typical clause is the methodology by which the price adjustment is to be undertaken. Methodologies vary and can, for instance, be by reference to the buyer's economic position. For example, requiring that the price allow the buyer to economically market the gas purchased. Alternatively, the methodology might require review by reference to prices under comparable contracts, gas prices in the end-user market, or comparator hydrocarbons or indices, for example, JKM, JCC, or Henry Hub. There are difficulties with each of these, of course. For example, if the measure is comparable contracts or recent LNG prices for imports into a relevant market, given the confidential nature of such contracts and the lack of a generally accepted global LNG price index, getting the comparable contract information can be difficult. More complex clauses also sometimes seek to limit the manner in which the price can be adjusted, for example, imposing caps and collars around price adjustment. That is, the price cannot vary by more than plus or minus 10%, or where components of price clauses are to be adjusted, the extent to which the price component can be adjusted itself. Again, the more specific the drafting and the more objectively clear the stated criteria, the greater the prospect of a dispute being resolved amicably and more guidance being available to arbitrators in the event of no agreement. I'd like now to deal with the second part of the question, which deals with whether or not we're likely to see an increase in arbitrations. Despite many Asian buyers being averse to disputes and both buyers and sellers having a clear preference to negotiate rather than arbitrate, I think that it is inevitable that there will be disputes arising from COVID-19. I expect that the disputes will be in two main areas, being around FM claims and price reviews. So given what I think is the inevitability of such disputes, despite them being very much unwanted by both parties, I'd like to give a few practical suggestions for prosecuting or defending the claim successfully. The first is analyze the details of the arbitration clause closely. Like FM clauses, there are no standard forms and the details matter. So make sure you meet all of the relevant deadlines in the arbitration clause for notification of dispute, entering into pre-arbitration resolution discussions, and referral to arbitration. As I mentioned earlier in relation to price reviews, failure to strictly comply with notice procedures can prejudice or potentially result in the denial of rights. The second is to optimize and maintain legal professional privilege. While the issue of whether legal professional privilege can be claimed in an arbitration context is a complex area of law in its own right, it is often recognized and is an important tool in managing disclosure of information and hence the prospects of succeeding in arbitration. The starting point in approaching privilege is to assume that all emails, notes, memos, reports, and other documents relating to the arbitration will have to be disclosed. So, where possible, do not produce them unless done through in-house or external legal advisors in accordance with protocols you've discussed with them in advance. This will likely mean that all communications with anyone involved in the matter, whether internal or external and including consultants, should be channeled through in-house and external lawyers. All communications should be marked confidential and legally privileged and put in a separate file marked legal advice, and of course, all information relating to the dispute should be kept confidential and not disclosed to third parties. The third is to secure the right expert or experts for the dispute. Expert evidence is critical in price reviews and FM disputes, basically all types of disputes referred to arbitration. So getting the right experts matters. Even if a formal notice of dispute has not been given, where there is potential for this to occur, parties should be considering who are the best consultants for the dispute and approaching them in advance to secure their services, even if on an advisory basis, in order to ensure that they're available for future use. Thanks, Steve. I'll leave it there.
Michael, thank you. As I expected, a very careful, logical review and some very practical advice. Now let's turn back to the Gaffney team. With buyers and sellers trying to settle on pricing mechanisms and the underlying value of natural gas in the energy mix, how will the role of gas in the energy transition influence those considerations? Andrew, what is gas's role in this newly emerging segment?
The energy sector, or the electrical power sector, is undergoing a lot of interesting developments at the moment with the growth of renewables power and with the decarbonization of the sector. Some time ago, Gaffney Cline was involved in a review of a gas-to-power development which was delivering into a small island-based electricity market. I think the supply dynamic demand playing out in that market is indicative of how the market could evolve over the many thousands of islands that are present in Southeast Asia. Now, demand in this market was dominated by residential and light industrial demand, although there was the prospect of some planned heavy industrial development in the future. So really the demand was peaking on hot days for air conditioning load, and other than that, fairly constant throughout the year. But on the supply side, electricity for this market came from coal-fired power stations, small diesel-driven generators. There was a wind farm, significant hydro, some emerging solar here and there, and of course the gas-fired power station that was the subject of our review. During the rainy season, the coal-fired output drops as the coal stocks get wet. I guess it was a low-budget power station. During the dry season, the hydro output falls. Of course, during the night, there's no solar, and the wind power generation was dependent on the wind. Now, if all these sources of power were online at capacity, the market was oversupplied, and so the electricity distributor should logically prioritize on cost, removing first diesel and then gas from the supply mix. It turns out, though, that gas's combination of reasonable cost, it's obviously cheaper than diesel, and responsiveness, and this was its key selling point, if you will. Gas could respond to significant load changes within 15 to 20 seconds, so long as it was online, provided a secure market niche for gas-fired power station. There was a base load to keep the plant running at minimum turndown, and then the gas-fired demand would pick up all the short and medium-term demand peaks that occurred, and put together that was a viable business for the operators. Now, of course, looking southward from there, there's a somewhat much larger island in the region called Australia, and there a similar dynamic is playing out, but on a much larger scale, and with the addition of LNG export, battery storage, a liberalized electricity market, and now a market that's seriously looking at hydrogen generation and export. This will be a very, very interesting development to see how this plays out over the coming years.
Andrew, thanks. Great information. Nick, you've been increasingly involved in the emerging role of gas as a feedstock for zero carbon hydrogen. How's that coming along?
Well, of course, Australia's been in the news as well for Shell's zero carbon LNG cargoes for CNOOC. And this is something we expect to see happening more as gas consumers focus on the carbon intensity of their supply sources. Longer term, though, questions around the role of gas as a source of zero carbon hydrogen are coming thick and fast from our client base right now. The reasons for this are very clear, and various promising solutions are under development. The economics of blue hydrogen are evolving quite rapidly, and we're working alongside our colleagues in our new carbon management practice that's been growing now for the last year or more. Now, I'm sure, as most of the listeners on this call are very well aware, in the post-COVID world, the demands placed on the energy sector by consumers are more than ever focused around decarbonization. We know gas is plentiful, we know it's low cost, but solving the carbon problem represents both additional investment and technical challenges. We're helping clients with three technologies right now, the dominant ones being steam methane reforming, or SMR, and autothermal reforming, or ATR. Now, both these technologies have been around for some years, more usually as a part of a wider processing plant, such as gas to liquids, for example, or methanol. With this approach, of course, a carbon capture option is an essential ingredient, for example, where CO2 capture can be accommodated in a depleted oil reservoir, for example, adjacent to the gas resources. Another emerging technology is pyrolysis, which produces carbon black, something akin to photocopier toner, which can be used in other processes as a byproduct and is a more secure way of capturing the carbon. Either way, as the challenges of using electrolysis to produce hydrogen from water are becoming clearer with each month that passes, blue hydrogen from gas is looking the more attractive option for most applications.
Nick, thank you. I've said often that the energy industry is a technology industry. This just shows it. Now let's take a look at the issue of risk allocation. Michael, back to you. Looking to the future of LNG contract negotiations, will we see changes in risk allocation in LNG contracts in a post-COVID-19 world? And in particular, will we see even more flexibility in LNG supply terms and mitigation options in Asia?
Thanks, Steve. For a number of years prior to COVID-19, the LNG market has been a buyer's market, particularly for good credit-rated buyers such as KOGAS, JERA, the Japanese power and gas utilities, CPC of Taiwan, and so on. Partly this has been due to an abundant supply from existing and new projects, lack of additional buyers with good credit ratings, and government regulations such as the Japan Free Trade Commission's pronouncement on take-or-pay provisions and, in particular, destination flexibility. Compared to 10 years ago, destination cargo flexibility, timing associated with exercising destination flex, cancellation rights, and UQT and DQT rights are far more beneficial to buyers than they were. In the new lower for longer environment we are in, I expect that buyers, especially those with good credit ratings, will seek to take advantage of that environment in new contract negotiations. Accordingly, I would expect to see further flexibility rights incorporated into these contracts and a push by buyers for sellers to take a greater proportion of the supply risk to obtain new contracts and retaining existing ones. There are a few areas here I'd like to touch on where I would expect to see, at the very least, a spirited dialogue. The first is in relation to force majeure clauses. From a buyer perspective, particularly a DES buyer perspective, I believe that buyers will need to consider how to avoid a situation similar to COVID-19 in the future. There have been difficulties, which Paul has mentioned, with parties claiming FM due to FM being derived from downstream issues such as local market demand collapse and then the inability to clear storage tanks. While not typically permitted as buyer FM, given it is a buyer's market, I would look for greater pressure from buyers to seek FM relief where there is a similar pandemic or other global incident causing significant upstream demand destruction and storage constraints. The second is cancellation rights. Normally, as Paul has mentioned on appropriate notice, cancellation rights would allow a party to cancel one or more cargoes in a defined period of time with some cap on the overall number over the life of the LNG SPA. In the face of a COVID-19 type crisis, greater flexibility in cargo cancellation, whether in terms of number of cancellations permitted or the time period within which a cargo can be cancelled, could have significant benefit to buyers. A similar argument could be made for increased DQT flexibility or shorter notice periods for the exercise of those rights. Another area where I would expect there to be discussion is in price review clauses. Here I would expect to see buyers wanting shorter periods between price reviews in order to minimize the risk of being in unprofitable positions. This was probably already on the cards pre-COVID, but I expect to see it more now, and particularly so if some of the other kinds of flexibility I've mentioned can't be incorporated into the contracts. Finally, I expect that we will see a continuation of a fairly recent trend towards somewhat shorter contract terms. So, in short, what I expect is shorter duration, more flexible contracts, as these provide the best protection to price and market fluctuations as buyers attempt to rebalance risk allocation in a post-COVID world. Thanks, Steve. Back to you.
Thank you, Michael. Again, very practical thoughts here. Now, Paul, what impact do you see this move to even more flexible supply terms, which effectively alter the risk allocation between buyer and seller, after all, having on the bankability of medium to long-term LNG SPAs, and will this limit a seller's access to project finance for new liquefaction projects?
Thanks, Steve. As Michael has pointed out, the question is no longer whether to offer flexibility around volumes, destination and scheduling. It's a question of how much to offer. When coupled with Michael's suggestions of a move to more frequent price reviews, whether that be triggered by market conditions or otherwise, changes to risk allocation to mitigate exposure to future pandemics and other catastrophic events, for example, if termination rights, for example, are negotiated in, and a move towards more volumes traded on a spot, short or mid-term strip deal, one has to consider what impact these proposals would have on sponsors and the lenders to greenfield liquefaction projects. Long-term SPAs still underpin the financing of many LNG liquefaction projects. The revenue from committed long-term sales constitutes the revenue stream from which the debt will be repaid. So project finance lenders will continue to insist on a certain portion of volumes from any new project being sold on a committed long-term basis. Without long-term certainty of revenue, liquefaction projects simply won't get built, or the sponsors will need to look outside the traditional limited recourse project financing structures to other forms of revenue or credit support to obtain financing for the development of their projects. Equity financing of projects is also an option, and we've seen that with the likes of Shell's LNG Canada and Exxon's Golden Pass projects taking FID. Having said that, there is certainly more tolerance among project finance banks and ECAs for flexible terms. Projects are now being financed with shorter term SPAs in place. It's common to see 10 to 15-year terms instead of the more traditional 20 to 25-year terms. And lenders are now more familiar with flexibility around volumes and destination, as long as base volumes are guaranteed. Projects also now can have 70 to 80% of their volumes contracted under long-term offtake, with more than 20% uncontracted volumes being acceptable to the group. I'd also just like to point out that for buyers in Asia, long-term security for supply is also a critical consideration. Not only will this provide a base level of support to long-term LNG contracting, but also perhaps limit the extent to which modifications to price review clauses and changes in risk allocation in respect of future pandemics and epidemics and other catastrophic events will be adopted, given these provisions can operate to work both for and against a buyer, depending on the location of the event, the impact such event has on market conditions. Thanks, Steve.
Paul, thank you. A complicated area, and you covered it well in a short time. So now it's time to start wrapping up our main discussion here, but before we move to the Q&A, let's go around the virtual room here with a question for several of our panelists around opportunities and how companies can respond to the current crisis to best position themselves for that post-COVID-19 world we all want to see so quickly. Paul, we'll come back to you here, given your experience working with LNG developers and sellers. Can you give us your thoughts on opportunities from a producer's perspective?
Sure, Steve. For those projects that have taken FID and for the larger portfolio players, once the COVID-19 situation has stabilized, whenever that might be, I think there is opportunity here for LNG suppliers to bolster marketing capabilities and undertake portfolio moves that strengthen their market position over the medium to longer term. Given ongoing global LNG oversupply, downstream integration, for example, investing in LNG regas and gas-to-power projects in Asia, is a significant opportunity as it extends a company's exposure to the broader value chain and also operates as a market creator for LNG supply, thereby guaranteeing continued market access. We're certainly seeing this already in Asia, particularly with the Japanese, Korean and Chinese participation in various proposed gas-to-power projects, and we expect that the majors will also be active in this space over the coming months and years. Beyond that, although we haven't seen a great deal in Asia just yet, perhaps beyond certain of our Singapore-based commodity traders, we do see opportunistic M&A, not just in the upstream, but throughout the value chain in shipping, downstream into regas and gas to power, as an option for some of the more well-capitalized players due to the likelihood of distressed divestments as we continue through this downturn.
Great. Thanks, Paul. Michael, let's jump across the table here. And what do you think LNG buyers should be focusing on now to best position themselves for post-COVID-19?
Thanks, Steve. Look, I think this really builds on the themes that I've discussed earlier. I think the key focuses for buyers here should be twofold. First, prepare to take advantage of the current market conditions by locking in lower prices under existing contracts and negotiating greater flexibility and lower prices under new contracts. The second is prepare to deal with post-COVID fallout. For existing contracts, I think this means reviewing them to see whether price reviews can be undertaken to lock in current lower market prices and preparing for the price review process. And that involves preparing your management for the price review process, ensuring the notice and trigger mechanisms are clearly understood, ensuring the negotiation process can be followed strictly, and that you have the capabilities to gather the evidence and experts you need for a successful price review outcome. For those buyers under existing contracts that have triggered FM during COVID and it was denied, prepare for the worst, because you'll either be triggering a dispute or being dragged into one. And where, if negotiation is unsuccessful, arbitration is on the horizon, understand the arbitration process. Again, get your experts lined up and make sure that your management and management processes are ready for what's to come. For future contracts, I'd suggest undertaking a strategic portfolio review to determine how resilient your portfolio is to future supply and demand shocks, and to determine your RFP and negotiating strategies for future contract negotiations. One final observation I'd like to make is to be aware of market disruption, and because it's been mentioned a couple of times here, I'll use hydrogen as an example. So hydrogen is an emerging fuel and can, under the right conditions, be produced by countries who have no historical hydrocarbon production background, for example, through broadacre solar or wind coupled with electrolysis. Also, the prospects of seaborne liquefied hydrogen delivery or seaborne delivery using ammonia or toluene as delivery mediums is evolving rapidly, as are demand-side applications, including in power generation. As hydrogen costs fall, so too will opportunities to displace LNG. This century, we've heard a lot about disruption of various industries, so buyers need to be aware of long-term contracting in the face of possible energy alternatives. So again, flexibility in contracts is pretty much key to having a sustainable future as a buyer. Thanks for that, Steve.
Yeah, Michael, thank you. I know you've been very active in the hydrogen space and, in fact, just published 2 articles recently about it. Nick, you also spoke about hydrogen earlier. Would you put your investment dollars into hydrogen? And what other promising opportunities do you see in the future of the LNG space?
Well, as you can tell, I'm a big supporter of the blue hydrogen business model in the longer term. But in the shorter term, I actually see other opportunities for gas. An area that we're seeing a lot of interest in, especially in the developing economies in Asia, is the potential for smaller scale LNG, both in terms of production and transport, and also in the applications it's being used for. And I think both Phil and Andrew's comments reflected this as well. Whether it's smaller scale power generation, industrial applications, or transport, modular, smaller scale liquefaction is really becoming a booming industry. Part of what's driving this, of course, is the increase in price arbitrage between wholesale LNG and retail fuels such as diesel. In fact, before the latest price crash, diesel was selling for around $30 an MMBTU in many countries around the world. And with LNG economics pegging the landed price at less than $10 for the foreseeable future, that leaves nearly $20 to pay for break bulk handling, smaller coastal shipping, and smaller storage and regas facilities, often floating. So the advantages of factory-built modular liquefaction in terms of time to first gas, reliability, and of course ease of commissioning are helping to drive this move towards smaller parcels of LNG, along with downstream developments such as high horsepower engines, gas turbine packages, and of course the marine trends towards natural gas that Phil mentioned, and away from heavy fuel oil. So in my view, gas still has a lot of mileage in a host of as yet unexplored downstream segments. Thanks.
Thank you, Nick. Really good thoughts there. Phil, you have the added advantage of being based at what some would see as the epicenter of the Asian LNG trade. What are you hearing on the street?
Well, thanks, Steve. From traders, we're hearing a lot of war stories about negative margin contracts and the expectation that it'll continue for a while. You have to remember the time frame traders' thinking is very different to producers. We touched on that a bit earlier. Producers, on the other hand, are looking at projects with cautious optimism. They look at a broader, longer-term economic canvas and see LNG coming back into its own. I think, as Nick just supported then, the global economic conditions in one way have provided an opportunity to reset. There are areas for growth, as we've discussed, shipping and hydrogen being two clear examples. The M&A market's alive. We're busy with interest in upstream transactions here at Gaffney Cline, and many of them are LNG related. There's a lot of money in the market looking for new opportunities, but it's money with a riskier appetite. We see some support for opportunities that are associated with long-term credit-worthy offtakes, parties that are shying away from the volatility, and then there's a lot of money looking for bargains and distressed assets. We haven't seen a lot of the distressed activity yet, but we, as mentioned earlier, we do expect it to come. Unlike in North America, where we are seeing distressed activity, but we are seeing assets change hands at realistic levels in Asia. There's a huge interest in carbon and carbon capture utilization storage, CCUS, at the moment, often coupled with hydrogen developments, and many traditional upstreamers are forming their positions on both. Alternative carbon markets are also gaining interest.
Phil, thank you very much. So lots of places for us to all look for opportunities. So we will now transition to Q&A. Please give us a few moments to compile the questions we have received, and we will be right back. Please use this time to submit any questions you may have through the chat box feature. Let's challenge these speakers here. So thank you all very much for your patience. We'll now dive into some questions. Nick, I think the first one will be coming to you. Where do you see CCUS requirements in the development of the hydrogen economy affecting LNG markets?
Thanks, Steve. Yeah, it's a great question, actually. And I think one of the interesting things we're noticing is the really big acceleration of interest in CCUS, partly out of the kind of stimulus money that's coming out of the sort of COVID post-recovery. One of the major steps forward in the CCUS landscape recently was a big NPC study in the US, which Gaffney Cline was part of. And certainly for those people interested, we've got a kind of CCUS calculator on the website, which is quite a handy tool for looking at the economics. But of course, as I said earlier, I'm a big fan of the sort of blue hydrogen business model, and I think particularly as some of the challenges around electrolysis come to the fore, gas for hydrogen represents really a huge future opportunity for the industry. But anyway, with that, I'll hand back, and obviously happy to take questions offline.
Okay, thanks very much. That calculator sounds really interesting. Michael, a question for you, I think, here. And it's, again, a very interesting question. And it basically is when you have price review clauses included in LNG SPAs that require a review for periodical basis, let's say every 3 to 5 years, and they provide for good faith negotiation, but they have no other clear criteria. What do we think about those? How strong would those be?
Thanks for that, Steve. Look, that sounds like it's an older style clause, maybe not necessarily in an older contract, but it certainly sounds like an older style clause. And many of those were little more than agreements to agree, and as such, they weren't enforceable. Look, good faith clauses, without more, in my view, are no substitute for more modern clauses because of what I referred to earlier in the presentation about needing to have a process and a methodology. Now, the reason I say it's no substitute is that there really isn't any consistent approach under, for example, English or Australian law as to what is good faith. This is by contrast to New York law, where there's a little bit more substance around what it means. So you're really left to what does the clause actually say itself. So is the clause actually going to, first of all, be binding, or is it really, as I mentioned earlier, an agreement to agree? Secondly, does the good faith clause actually have something of a process in it that you can hang your hat on so that the parties are able to say we need to agree within a particular period of time, and here is how we're going to go about those negotiations. So at least got an ability to be able to say this is how we have to proceed, and if you don't, then there's a breach of the term. The next is, does the clause itself specify what good faith means? That's always quite helpful if you have a good faith clause to have some form of definition. So hopefully if the clause itself is a binding clause and it says how the parties must negotiate, i.e. what period of time, and then separately says here's what the outcome is that we're looking for in terms of price, then it's possible. If you don't have that, then I think it's not really a great position. Potentially, though, all is not lost. You'd need then to look at other things, such as are there consequences for no agreement? So the first thing is obviously there'll be a commercial consequence relating to the relationship of the parties, but is there something else that might focus the parties' attention? So, for example, if you don't have a good faith outcome negotiated, then can one of the parties terminate? Or is there an automatic referral to arbitration? Now, if you don't have those things, then I think that it's really just down to the parties trying to come up with a solution, and that's probably going to be based more on relationship. So if you're a buyer trying to rely on a clause like that, and it doesn't have any of those things that I've mentioned, then I suspect that you're not in a very good place. Having said that, if you're a seller, then not having any of the types of requirements that would compel you to modify the price probably is not a bad outcome in the current environment. Look, happy to discuss that further in a separate question or offline, but I'll leave it there for now. Thanks, Steve.
Great, Michael. Thank you very much. Here's another one. We heard quite a bit about LNG bunkering. So this one, perhaps Phil, Andrew, what is the potential for LNG bunkering in the Philippines? And any way to quantify expected demand?
I'll have a quick response to that, and Andrew can probably follow up. It's the LNG bunkering for a long time has been a chicken and egg sort of proposal. I think we'll see it emerge on the major routes first, the new high efficiency vessels traveling between, let's say, Los Angeles and Singapore and Shanghai. I think on a lot of the bilateral routes. Iron ore carriers are good examples where they're going to and from a point where a bunkering can be established, will be the next ones. But once you have that network beginning to be established, you'll see a lot of secondary bunkering going on, and vessels will be able then to travel to and from their ports. So for the Philippines, if they want to attract the larger, high efficiency vessels, then I think they'll need to establish bunkering. What has emerged lately, though, and what is of more interest, is the technology to establish bunkering is relatively easy now. To put in a floating storage and regas unit alongside a bunkering tender is a relatively low and in lending terms, relatively easier proposition to secure money for, because of course a lender can securitize against a floating vessel and take it away into a market which is developing some depth now. So I see it as one, relatively simple to do, and B, necessary if you track those larger vessels. But Andrew, you might want to add the benefits, other benefits to that.
Yeah, thanks very much, Phil. I think the role of LNG for bunkering in the Philippines is probably going to be preceded by the role of LNG in power generation in the Philippines. I think the one is a logical follow-on from the other. And of course, the role of LNG in the power sector in the Philippines is more or less a supply-demand balance between Malampaya and how much longer it's going to be able to contribute to the market, and country gas demand. We've seen a lot of talk around LNG import terminals being discussed in the country. There's one facility under construction and has been for some time, and others under serious consideration. To put a time scale on it and to see how the market will grow, I think probably one ought to look to Indonesia and see how the growth of LNG has developed in the market, and there it's very much driven by the commercial and regulatory treatment, and is not an overnight development. I think it will grow quite slowly over a long period.
Very good, and I think those are all good points here. Let's take just one more question. We did get a couple that have just rolled in, but we're going to need to get back to you on those, unfortunately. But we'll take just one more here. And Paul, I think this one can come in your direction. We've been reading about Shell's ambition to be a supplier of carbon neutral LNG, and also Pavilion Energy's recent tender for LNG cargoes with carbon offsets. So how do you see net zero LNG developing? Do you think it'll become commonplace?
Yes, thanks, Steve. It's a very good question, and obviously something that a lot of people here in Singapore are no doubt aware of, particularly in the context of the Pavilion tender. For those that perhaps aren't aware or outside the region and dialing in, Singapore-based Pavilion Energy launched an RFP in March of this year for, I think it was around 2 MTPA, with a requirement that the potential suppliers submit a proposal around the joint development of a greenhouse gas emission quantification and reporting methodology. They're also encouraged to include proposals around their GHG reduction as well as to offset carbon from the delivered volumes. Shell, as you rightly point out in the question, has also been very active in this space, and earlier this month signed the agreements with GS and Tokyo Gas for delivery of carbon neutral LNG using nature-based credits to compensate for those CO2 emissions. So it's certainly something new, and I wouldn't say it's commonplace yet, but the question of will it become commonplace in the market? Possibly, but there's work to be done. For example, there isn't yet a industry standard for quantification of GHG for LNG delivered. And perhaps this is where the processes like the pavilion tender can certainly help develop those. But I don't think this should be solely on the shoulders of the private sector to develop government policies. I think we'll need to incentivise the move to net zero LNG before it will become commonplace. And I don't think we're seeing that just yet. I think, for example, in Japan, government regulations do not account for the scope of emissions. So the buyers at the moment aren't necessarily getting the credit for procuring lower carbon LNG in the import markets. So I think it will take time, but given the demand side of the equation here for more green LNG, I think it's certainly an area that market participants will continue to focus on.
I think that's undoubtedly the case, Paul. Thank you. So let's just wrap up here real quickly. We'll be posting a recording of today's presentation to the Akin Gump Speaking Energy blog, and it will also be included in Gaffney Cline's Energy Insights publication, which is really useful. I very much enjoy getting it. I want to again thank the Gaffney Cline team for the cooperation here, and I want to thank the great speakers, and I certainly want to thank all the great attendees who came. We know your time is valuable, and we really appreciate your having spent some of it with us. Thank you very much.